Hello friends, welcome to Finideas. This is our 6th video in the series. To watch the other videos, their links are provided in the description box. Today we will dive into the world of trading and discuss an essential concept, the index. We will learn what an index is and understand its significance in the trading market. So let's get started. What is an index? An index in the trading market refers to a statistical measure that represents the performance of a specific group of stocks or assets. It serves as a benchmark to track the overall performance of a particular market, sector, or economy. In simpler terms, it's like a snapshot of how a certain group of stocks is doing collectively. Types of indices. There are various types of indices, each serving a different purpose. So let's discuss a few popular ones. First, stock market indices. These indices reflect the overall performance of a stock market. For example, in India, we have BSE Sensex and the NSE Nifty, which represents the performance of a Bombay Stock Exchange and the National Stock Exchange respectively. Second, sector indices. Sector indices focuses on specific sectors within the economy such as banking, IT, healthcare or energy. They help investors understand the performance of individual sectors and make informed investment decisions. Third, global indices. Global indices like S&P 500 or the Dow Jones Industrial Average in the United States provide a broader perspective on the performance of international markets. They enable investors to gauge the global economic trends and make strategic investment choices. Now that we know what an index is, let's explore its significance in the trading market. First, performance measurement. Indices act as yardsticks to measure the overall performance of a market or sector. They help investors assess whether their investments are outperforming or underperforming the broader market. Second, market sentiment. Indices reflect the market sentiment and provide insights into the collective psychology of traders and investors. If an index is performing well, it indicates a positive market sentiment, while a decline may sign a caution. Third, portfolio diversification. Indices enable investors to diversify their portfolio by investing in exchange traded funds, ETFs, or mutual funds that replicate the index performance. This diversification reduces the risk associated with the individual stocks. Fourth, investment strategy. Indices serve a reference point for investors to develop their investment strategies. By analyzing the components of index, investors can identify potential opportunities and allocate their capital accordingly. So that's it for the video. Thank you for joining us today. If you found this video helpful, don't forget to like, share and subscribe to our channel for more insightful content. If you have any questions or suggestions, please leave them in the comments below. Stay tuned. See you in the next video. Happy investing.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.